Good afternoon. Slight change to the agenda that you've got. I'm Peter Wilson, another Peter Wilson, taking over from Jonathan today, who's unfortunately been called away on an urgent meeting. So we're going to talk about the subject of compliance, disclosure, transparency, and effectively how do wealth tech firms stay ahead of the curve. Quite a broad area, and I'm sure there'll be some interesting points. Today I'm joined by Aloysius from AltFi Data and also Alex Pillow from RDC. I think just setting the scene, at Taylor Wessing, we do a lot of work in the corporate technology space, acting for VCs and angels looking to invest into fintech businesses. And as a regulatory lawyer, compliance is often a very core issue when they're doing diligence. And it is often one of the big sticking points when looking to put money into fintech businesses, particularly when businesses are in the startup phase, because often the compliance doesn't necessarily get the full attention that perhaps it deserves. So I'll just put that context there, and perhaps we can talk about that a bit more. In terms of how we'll run this, I'm going to ask Aloysius and Alex a few questions, and do feel free to chip in as we go. So I'll let you introduce yourselves. Aloysius, just be interested to hear a bit more about the business that you're involved in, what your customers are, and also how your business fits into the wider fintech space.
Certainly. So at AltFi Data, I'm responsible for developing the overall product offering that we have. And our focus is providing transparency and analytics for, at this point, primarily for the P2P, the marketplace lending industry. This is an industry that has grown dramatically over recent years, and our view is that for any new asset class, for it to really thrive and scale, there needs to be an associated third-party independent provider of analytics and transparency. So we take data in from the originators, the raw data on their loans, how the actual cash flows, and we generate analytics that represents the performance of their overall book, so that the investor community, both retail and institutional, can then take a view on how they perform. And most importantly, we do that in a way that is comparable. So we take out individual interpretations that different originators may have on the way they provide their analysis, and we provide a uniform methodology across all the originators so that you're comparing like for like, apples against apples, in terms of the type of analytics.
Thank you. Alex?
So RDC work across the financially regulated industry, based in North America and been around 15 years. In the last 2 years, we've really taken an interest in this market, in the fintech market, of which wealth tech is a part. And what we're actually doing is trying to help these companies to do all the regulatory stuff they need to do, as well as any additional risks that could harm them reputationally, flag those earlier, monitor them so they're never behind the risk, but do it in such a way that it doesn't impact their customer acquisition models, ensure the onboarding time is as short as possible with the least amount of workload. As we'll note, one of the big sort of differences between our traditional finance clients and our newer ones is simply headcount. So it's all about bearing down on that workload so they can continue to challenge the market.
Thank you. And I was just going back to you, in terms of your experience in the peer-to-peer lending sector, what parallels can you draw on them from a disclosure and transparency perspective, looking at the wealth tech space?
I think there are some very interesting parallels, because ultimately it comes down, as David mentioned in the previous discussion, the most important thing that the investor has in their mind is the return they're getting. And so one of the key things that we focused on with regard to marketplace lending is trying to represent the overall returns. What's the risk-adjusted return? What is your return relative to the losses that are being experienced in a portfolio, and providing that insight in a uniform way. And I think this is something that the robo-advice community can start to take on board as well, trying to represent the returns of investors across their portfolio of investors in a way that that describes their experience in a uniform through a uniform methodology. So I think the robo-advice is perhaps a little younger than the peer-to-peer market industry, but I think it's something that they can start looking at so that investors can really take a view as to how they perform.
And have you seen that happening at all in practice at the moment?
I have seen some. I know some have started to implement their own methodologies, and of course, our view is that, well, that's fine, but that doesn't really provide an independent assessment, a third-party assessment. But for example, I believe Scalable Capital has recently issued their first year of performance, and they have a certain methodology or a certain process in how they manage their portfolio. So they've had to develop a methodology specific to that. But so we're starting to see platforms doing that. The question will ultimately become is like, okay, well, that's great, but how does that compare with another platform?
Interesting. Another thing we've heard today is about collaboration in the wealth tech space with existing institutions forming partnerships. To some extent, the peer-to-peer market is a little bit ahead of a curve on that. What's your experience in that market? What's been driving that? And again, is there any learning across the marketplace lending and the wealth tech space?
You mean peer-to-peer collaborating with
other financial institutions, say for example, Zopper and Metro, or Saffron recently?
So there's certainly that. I think as these platforms are maturing and scaling, one of the challenges they face is growing their origination, feeding the machine, as it were. And so they're looking for partnerships, collaborations, which then provide them with new distribution channels or new channels which feed them more origination. So I think it's a natural fit that they would find partners in the other digital banking spheres. So there was also another example recently with was it LendingWorks, LendingCrowd, and one of the digital banks providers. Revolut, yes, that's so there's another great example of a peer-to-peer lender which is partnered with a digital bank, which then feeds them more origination. So I think the role of advice is going to be another dimension to that. I think with time, and I've heard some people in the robo advice community, explicitly express that view that they see an opportunity there in the future.
Thank you. Alex, coming to you now, obviously we hear a lot in the market about RegTech, regulatory technology, and how tools are helping firms to manage and mitigate compliance risks in business. From your perspective, where do you see the key risks when originating and onboarding new clients?
I always say that RegTech is a term that our office absolutely hates.
Sorry.
I think it's just because we're a firm that was around before the term. I suppose when we work with peer-to-peer or anything where you've got money coming in and then you're also picking where it's going, is to screen those two sets of people differently. So when you're looking at risk from a regulatory perspective, there are certain prescriptive items, i.e. sanctions list. Has to be done, it's a yes or no. But there's the next phase, which is more grey, and you've got to take that risk-based approach regulators look at. So call it customer due diligence, you can call it enhanced screening, you can call it whatever you want. What we really see is that most of the guys in this space want to segment their client book because, speak to Ian's point, if you're only making £10 a year, do you want to go beyond the bare minimum, sort of a sanction and pep check? Not really. But as you go up that scale and you're bigger clients, they may pose you more risk. And if one of them turned out to be pushing money or they dirty money or they had something going on else and a story broke and you got caught up into it, that's probably the end of your platform. So it's about segmenting that. And also, as you see, some of the certain platforms that are marketing themselves as they're investing in sustainable business or green business or whatever, the more discerning investor may want to know what due diligence you're doing. How do you do that? Do you employ people to sit on Google? One of our nice taglines that we get to use is Google use us instead of Google to do their due diligence, because we're looking only for risks. And so the type of screening that they do on their borrower side or investment side is very different to what they do on the people they're onboarding.
In terms of actually how your product works, how does it actually bolt into a firm, and how does the solution work?
Really varies, depends on who the firm is, what they want to do, the resource. If we're looking at this sector, it will be driven by API, either directly with us or through partners, where we've integrated into end-to-end solutions. Where we don't handle document verification, for instance, but there's lots of good people for that. No reason not to have a one-stop shop, but get the best of both worlds. There are others that we're going to take a more manual approach, but when you're looking at 1 minute or less than 10-minute customer acquisition, it's really the API that drives it all.
From your perspective, do you think long term that technology, obviously RegTech's a buzzword, but solutions like that will ultimately be the way that compliance will work in the future, or do you think it will still have a human touch?
I think you'll always have a human touch, because people talk about AI, and I know, having coffee with a few people, it's a term that maybe not all of us have faith in. It's still early stage, but ultimately, as the FCA guidance is, that there's still going to be a person that's responsible. If you're the MLRO, it's still your career on the line. If you're the CEO, it's still your business on the line. What we're looking to do, part of our solution that we've had for over a decade, is a team of analysts that basically will do first level false positive review. We've captured those data points on an anonymised basis. We have over 3 billion decisions that are ready. When the AI catches up to the data we have available, we can teach it those decisions. You can then create a digital compliance analyst to remove that headcount requirement, but you're still going to need that ultimate decision maker for anything that makes it through that process, so that you have somebody who ultimately is responsible and advises the business and the commercial business on what they can and should do, and what's going to get them in trouble, not get them in trouble.
Interesting. And there was mention in there about AI. So one of the things that was talked about earlier today, and I don't know if either of you have a perspective on it, was essentially about how platforms using smart web-enabled solutions to essentially track how customers are moving through the site. For example, on a wealth tech platform, how that informs around suitability assessments. I don't know if you have any views on using solutions like that, if you've seen anything in the market.
Not so specifically. What we're seeing that's quite interesting in this market versus some of our more traditional clients or traditional finance is the idea of, rather than having blocks to onboarding and getting going, they'll have various soft or hard locks. So if there's a certain flag but it hasn't yet been assessed, they may let you on board because they don't want to have you fall out of the funnel, but then there's going to be a lock on your account to how much you can put in until that's cleared. Or if it's a high enough risk, it's just going to hard lock you. Actually, we'd rather have you out of the funnel, potentially lose you, rather than take the risk. So there's different flow charts that can be created off the back of our data structure. And that's quite interesting because there's more experimentation going on in this market, where perhaps they have more freedom to do that because they're not as scrutinised, potentially, as our larger multinationals.
Okay. I think I'll leave it up to the floor. We're slightly constrained on time. So does anyone have any specific questions on the points that are here? I don't know if you've got any closing thoughts at all.
No. I mean, people would have a coffee or a beer or whatever, happy to sort of talk through what they're doing, what we're doing. But I think ultimately, from our point of view, it's interesting watching how whatever tech is changing how they use the same product by changing their operations around it, versus there's been a traditional model that lots of people have replicated, but there's less experimentation. So whether there's a competitive edge there or not, time will tell, but it's fun being the guy that gets to see the different data points and who's winning, who's losing, obviously all on a confidential basis.
Thank you. So I think from my sort of closing perspective on this, and I think Alex said it well, ultimately in business, in regulated businesses, that there still needs to be someone on the hook for the compliance oversight, and that goes right up to the board level. And I think the regulator certainly hasn't forgot about that, and there's going to be increasing focus, particularly in the wealth and asset management sector, with the senior managers and certification regime next year that's rolling in. And again, that's really putting personal accountability in the spotlight. So, I don't think compliance, disclosure and transparency is going anywhere soon. So Thank you very much.